Okay, welcome Octay to the Cash Flow Mindset YouTube channel. Thanks for working with the community over all these sort of months we've been going back and forth, and you've been really reactive on WhatsApp even. Thanks for sharing that because I know that that's personal to you. So, I appreciate you coming back to me even out of hours. So that's been really good. For those of people that aren't familiar with IncomeShares or your income products, can you just tell us a little bit around IncomeShares themselves and a little bit around your role and what you do for IncomeShares?
Yeah, sure, absolutely. So first of all, thanks a lot for the invite. I really appreciate what you guys do for the entire community. I mean, I really appreciate like the feedback that we get from everybody and all the different types of questions that we're getting on a constant basis. So it's really great to see. Maybe I can just take like a step back and sort of explain how not just IncomeShares, but the whole company sort of started out, right?
Sure.
We go all the way back to the end of 2017. People are maybe familiar with the ETF wrapper and maybe even leveraged ETFs, which is what we're best known for. We were actually the first company globally to launch what's known as the single stock ETP, right? So it's kind of like the opposite of what you would expect when you think about an ETF or an ETP. Instead of getting that diversified exposure with a single trade, we actually took that approach and applied it to individual stocks and applied leverage to it. So we're the first company to launch single stock leveraged ETFs globally. We started back in 2017 with 8 products initially, and those were with lower leverage. But having spoken with all types of institutional and retail investors and high net worth individuals, we sort of saw that the demand was in a particular subset of big indices. So that's mostly focused on tech names, and people essentially wanted higher leverage, right? So in Europe, we can actually do a few things that are not doable in the US, for example. And we just were best known for launching products like 3 times Tesla, triple leveraged NVIDIA, inverse versions of all of those. So nowadays we have over 160 products listed across the biggest exchanges in Europe. So we have them listed on London Stock Exchange, they're in Germany, they're in Amsterdam, they're in Italy. So basically all of the biggest exchanges. We saw IncomeShares as sort of the natural evolution of the platform, right? So we're used to launching products. We have a lot of experience with it. And we saw this as a trend that was really taking off in the US. And what you usually see is whatever happens in the US, after some
Yeah.
time, it sort of catches on in Europe as well. So that was the mindset behind the launch of the product. When you look at the team behind the entire business, we come, I would say, from a pretty strong pedigree of launching ETFs, right? The CEO and the co-founder of the company, Jose Gonzalez, he was one of the co-founders of Global X, which is nowadays one of the biggest thematic ETF issuers in the world, right? And they also launched the first ever covered call ETFs. So it's not like we're just learning from scratch or just starting out. We've been doing this for a long time, and we're just starting to improve, and we're working on becoming better every single day.
For the viewers that don't know, that grandfather fund QILD, which is the longest running, I think it was one of the first ones that ever got kind of released as a kind of fund for cover call. So that's great to hear. So can you tell me a little bit around what you do for IncomeShares, what your role is, and kind of what you do sort of day to day?
Sure, absolutely. So I'm basically in charge of all external communications and firm strategy. What that basically means is if we're doing anything around press releases or if we have interviews lined up with media, basically anything that we communicate externally sort of runs through me. And I'm also very much involved in everything we do around marketing. And I play, I would say, a pretty big part in deciding sort of which new products to launch, which markets to enter, and sort of which direction we want to go with the companies that we're currently running.
Great. And I know you're a lot more active on Twitter, so the community really appreciates that. And for those of you that you're not on Twitter, make sure you follow Octay because he does share a lot of good information. I believe you've also got IncomeShares direct handle as well on Twitter as well, right?
Yes, yeah, absolutely. So, I mean, I try to post a lot of content for both sides of the businesses, but I love social media. I've been active for long before IncomeShares,
Yeah.
so I try to respond as fast as I can. But yeah, please try to bear with me because sometimes we have days when things are really hectic, so it could take a little bit longer than usual.
No, it's good. I've seen you've kind of been on X. You've been posting the questions back that you've received and posting the answers on X, and you've been a lot more active. So I think the community has appreciated that clarity that's coming through now.
Nice.
At the start, there was some little bit of nervousness there, but I think people are now seeing that happening. So help me understand, everyone's familiar in the community with these ETFs, this
Yeah.
concept of ETF. When Vanguard, which is the biggest provider of these, started producing all of these, and everyone's familiar with some of them. But just give me an understanding of the difference between the ETP and why you call it an ETP and not an ETF.
So the way the term ETF is used is like a catch-all term for everything that's exchange traded and offers you sort of diversified exposure to whatever, all subsectors of it. Could be an index, it could be a theme, it could be commodities. The way regulations in Europe work is if you have very concentrated exposure, you can't call it a fund, because to be a UCITS ETF, you need a certain level of diversification that's present within the product. So just to give you an example, a gold ETF in the US exists, but a gold ETF in Europe, it doesn't exist, right? It's an ETC, which when you look underneath the hood, it's essentially the same structure as an ETN, essentially. So ETCs, ETNs, they're basically the same. What you have to really pay attention to is whether the product is collateralized or not collateralized. So that's where things sort of get a little bit wonky. But, long story short, if it's a concentrated exposure in Europe, you can't call it an ETF. So it has to be classified as what we call an ETP.
Okay. All right. So it's to do with the diversification within the fund itself.
So essentially, ETP is the umbrella term underneath which you have ETF, ETC, and ETN. ETFs are the ones that most people are familiar with, and ETP is the structure where you can get sort of like the more niche exposures as similar to the ones that we offer.
Who are these funds made for? And why? What are the benefits? What are the pros and cons? What's the trade-offs? And why would they choose IncomeShares over some of your other competitors in the space?
I started going down the rabbit hole of income or dividend investing a few years ago, right? Because what we sort of saw post-COVID is that everybody was very interested in the growth names, right? Everybody knows about like Cathie Wood's Innovation Fund. Everybody knows about the boom in the tech names, that a lot of those fell off a cliff afterwards. Some of them sustained that growth. But most people didn't care about income when everything was going up, right? And interest rates were essentially at zero. So no one was taking interest in alternatives. And then what happened was interest rates went up, and then people all of a sudden started looking for a more balanced approach to their portfolio. And then people started paying attention to alternatives, right? Because all of a sudden your tech portfolio isn't doing as well as it was doing in the past. So all of a sudden you're looking into alternative exposures. And when you're looking for alternative exposures, you're also looking for alternative means of income, right? So people were traditionally used to things like investing in fixed income, REITs, and whatnot. And investing in dividend stocks, and in the traditional sense, is not everyone's walk in the park, because they don't pay out monthly. The yield could be relatively low compared to what a lot of, especially retail investors, are looking for. That's where the advance in the ETF space overall was great for the average investor, because all of a sudden you take this wrapper that everyone's familiar with, and you can wrap strategies that have previously been available to institutional professional investors, which are option strategies. It could be other trading strategies, but essentially it's packaged convenience, right? That's what an ETF is. These products are basically meant for those people that are looking for monthly income. These are people that want active income on a regular basis, that can use that income whether to reinvest into their existing portfolio or use it for their everyday expenses, basically.
Yeah, there's been a lot of discussion. In fact, I did a video, I'm not sure whether you saw it, around income growth. And I think it was a good, interesting thing around when you get these distributions back, what do you do with them? There are some people that are trying to compound the income, right? So you reinvest back into these funds, and then hopefully you get a higher payment next month, just compounding your shares in effect. And it's obviously a share amount that your distribution payment is based on. And then there are other scenarios where people say, no, I want to divest to growth, right? Or I want to look at some other funds, or I want to, as you quite rightly said, use it to pay my bills. And I think it depends on what age bracket you're in, right? Depending on what almost you're doing with the money. Typically, your older generations don't have the time horizon for the growth, so they're looking for that income, whereas a younger investor might be using some of that to compound their growth. And I think you quite rightly highlighted that, everything always sounds good in a bull market. Even these option strategies do well in a bull market, right? Everything does well in a bull market, but obviously the challenge is that in a sideways or downward market, you might have waited 10 years for your stock to go up and it gets wiped out in 30 seconds with some statement that's come out in the media or something that's just gone wrong in the markets. From your perspective, are you seeing a lot of people reinvesting, or are you getting people that are typically just taking this out and putting their money elsewhere? What are you typically seeing in the inflows of the funds?
I think that's been one of the more encouraging parts of this whole income share story because since launch, I think we've had something like just one or two redemptions. What that means is we have new money constantly coming into the product. To me, that signals people reinvesting into the funds or investing for the first time. So we've seen this more buy and hold mentality with these products, which is a very different sort of audience compared to the leveraged offerings that we have. And that's why we call this sub-brand income shares, right? We want to really have that divergence between the two brands to make sure that these products are for people that are looking for monthly income. They are not leveraged. And if you're an active trader looking for the other stuff, then you can find that as well. But these income products, I would say, are this is the hottest corner of the ETF market by far. So this is basically at the epicenter of the three biggest ETF themes right now, which is active, single stock, and options based, right? So this is really sort of capturing all three at once. So the more products that are out there, the more beneficial it's going to be for the end investor, right? Because I always say when many companies compete, the end investor is the winner because you're trying to get their support. And the only way to do that is with good performance and with quality products that have basically proven themselves over time. So yeah, I mean, I really see these products, I really see this category growing over time in leaps and bounds. And we even see it in the US right now, right? So you see every single week, if not multiple times a week, a new issuer coming to market or existing issuers launching new products around new strategies or adding leverage on top of the strategies. So it's great to see, honestly. I mean, there's never going to be a lack of supply of good ideas. So I'm all for it.
Yeah, and that's good. And I'm glad you brought up the active part in that conversation, because we've been going back and forth over comms around a lot of people in a community saying, oh, it started off really simple at 5% out of the money, and it felt like it was a lazy man's approach, and a bit like QILD, which pretty much runs at the money every month, set and forget. It's very passive. And we're also sort of talking about how almost being too active can also be counterproductive as well, right? There's this kind of sweet spot that every fund is trying to get to. What is the right combination of being active but not overly active, or how do you set the right strategies? Do you run certain option strategies? And I've done some videos around that. So, but I think that bit's quite crucial. And you've kind of gone through this iteration now where you started to change the strategy. You went from calls to puts on some of the funds, not all of them, obviously, but the gold and silver, I think, still running on calls, right? But you've got puts, you've got laddered puts now. Do you want to talk a little bit around what's changed, why you've decided to change it? And I think you've got something to share as well in terms of some of the data as well, which I think will be quite interesting for the audience to also see.
Yeah, absolutely. I would really love to clarify a lot of those points. Before going into a lot of detail about what we did and how it's changed over time, maybe it's good to take a step back and sort of explain how the entire sort of ETF, ETP ecosystem works, right? Because we can't on our own make a decision on what we want to do, right? We have to get a green light from multiple parties. So these are regulated products listed on regulated exchanges. So we have to get a green light from the exchange, let's say the London Stock Exchange. And then we also have other counterparties to work with. So we have custodians, we have market makers, and a lot more. So when you talk about the market makers in particular, right? So these are the companies that are pricing the product on a daily basis. So they're the ones providing the bid-ask spread, right? And if you compare these to a traditional, let's say, S&P 500 ETF, right? It's very different from those plain vanilla index trackers. So we had to sit down with the market makers, and then we have to talk about what's doable, right? Because if you compare the ETF market here, or I should say the options-based ETF, ETP market here compared to the US, there's a big difference in that you don't have the overlap in trading hours, right? So unlike normal stocks, you don't have pre-market trading, and you don't have after-market trading in options.
Mm.
So that makes it very difficult for them to be able to price options-based ETPs during European hours. So with that, and we were, as far as I know, the first company to not only do single stock options ETPs, but also zero DT options ETPs, and the more concentrated exposures where we actually had weekly options, right? So
Yeah.
there was existing products, but they were either monthly options or maybe even longer term. So that's why when we started out, we had to approach it a little bit more conservatively. So it had to be pretty static, honestly, right? So I completely agree that choosing the same out of the money strike levels for the calls initially might not have been the best strategy for all of the underlyings, but it was sort of one of the first ways that we could get started with these products, right? So we had to have the market makers become comfortable with the pricing. We had to make sure we build our own infrastructure, right? Because
Yeah.
unlike many other companies, we have our own traders, we have our own active decision making here, and over time we've helped sort of ease the mindset of the market makers into becoming more active and becoming, I guess, a little bit more picky in terms of which strikes and how we roll the product, etc. So I would say that it wasn't easy to launch these products, right? So we were the first to market, and I can honestly say that others really benefited from the
Yeah.
fact that we were the first to market, right? So when we first launched them, let's call it phase zero, right? So it was
Yeah.
really straightforward, but it was limited. So what we've done over the last, I would say, 2 months, and believe me, it's not just like flipping a switch and putting on the new strategy, right? It has to go in phases, and every single phase has to be actively communicated with the market makers and other counterparties to make sure everything's working smoothly and they can properly price the product and manage their risk internally according to their own rules. So we went through phase one, which went live recently. And by recently, I mean like probably over a month, more than a month ago now. But we added a decay rule, right? And then we have this smarter expiry selection. So if the options decay early, we're able to lock in those gains and redeploy, meaning write new options. And then we introduced phase two, right? So that was the multi-strike model. Instead of just having a single strike, we were able to split those exposures into two. And we also added an equity sleeve because one of the biggest issues with a covered call with 100% overwrite is that you're fully capping your upside.
Yeah.
And what we all know is that sometimes stocks do things that you don't expect from them, even
Yeah.
the ones that are very volatile, right? So you really, I think this equity sleeve portion is very important to be able to participate in the upside as well. And then the latest phase, which we introduced last Friday, was basically picking strikes based on the level of volatility of the underlying, right? So
Right.
obviously we have
Okay.
some restrictions as per the
Yeah.
prospectus, but now we can be a little bit more selective in terms of which strikes we want to pick based on the volatility of the underlying. So I think what you'll see starting from this month going forward is going to be very different from a lot of investors in terms of performance until now.
Yeah, and it's interesting. You've got this 75% and then 25%. Obviously, 25% being in the pure equity side of it, whatever the
Yeah.
underlier is. It could be Google,
Eh,
Coin, whatever. Do you write the full 75%, or are you writing a proportion of that? Because obviously, you've got to protect
Yeah.
being a put. You've got unlimited downside potentially. So
Yeah.
so how much of that currently are you writing from a put right perspective?
So the aim right now is to keep 25% all the time as an equity sleeve, and this is for the cash secured put products. And the full 75% remaining is fully deployed. So that's split into two, so 37.5% each. And then those are written on multiple strikes. And if the premiums were to decay very quickly, meaning if the underlying was going up on a Monday or Tuesday, we're able to close out those positions and write new puts it could be the same Friday or it could be the following Friday. So we're able to capture more extrinsic as the underlying is moving up. And because I feel like the cash secure put element is a lot more confusing for many people,
It is.
just because
It is.
the covered call concept has been around for a lot more. It's a lot
Correct.
cleaner, right? You just have the
Yeah.
stock, and then the only cash element is the call sold. So I actually put together like a few screenshots just to show like the good in terms of what's worked with our strategies and
Yeah.
also the bad, right? Because we want to keep this objective, right? So just give me a second to pull this up. Okay.
And just for the viewers sort of less familiar, maybe watching this for the first time, Extrinsic is the time decay element where they're getting the premium, and then that's the bit they're distributing to us as investors. There is another portion which is referred to as the intrinsic, and that's the bit they're keeping within the fund itself. So just to kind of clarify why Octay is particularly called out the extrinsic there.
Absolutely. No. That's thanks for clarifying. I mean, I think you do a great job on your videos and sort of educating the community. But yeah, I mean, I think these are concepts that people are going to become more and more familiar with over time. But yeah, I think what they'll come to realize is that you're essentially looking at two sides of the same coin, right? One of them has a few advantages in our view, which is why we deploy this strategy now compared to the more, I don't want to say vanilla, but the more traditional approach before. But before we go there, I mean, I just want to show a few examples, right? So when we had the static 5% out of the money calls written, that's a decent strategy for companies that aren't very volatile, right? So if you look at a stock like Amazon, you don't expect Amazon to move 10-15% on a single day, right? This is a company that's been around for a very long time, and on a daily basis, it very often moves less than even 1% or maybe slightly over, right? It's not a very volatile stock. So in these scenarios, what happens is you're actually able to capture a lot of the upside because that 5% weekly cap isn't usually reached in many cases with a stock like Amazon. So that's what you see here in this chart. So maybe I can even draw here, right? So if you see a steady growth like this and your cap is 5% on a weekly basis, you're essentially able to capture the full upside. And then as we know, there is no downside protection with these products, right? So basically the underlying ideology here is if you don't like this stock, I'm pretty sure you're not going to like the options-based product around it. So if the stock goes down, you're going to participate in that downside. But the key thing when everybody talks about NAV erosion is that you're not covered on the downside. I mean, you're not protected on the downside, but on the upside, you're capped. So that's the element that we're trying to fix with the strategy update that we've implemented now. So with Amazon, our Amazon ETP, you've seen that over, 343 days, so almost a year, it's even outperformed the underlying, right? So this is one of the underlying scenarios where the product has actually done relatively decent, even given the static strategy. Here's where things get quite ugly, honestly, right? Because when you apply that same approach to a very volatile name like Coinbase, which could move 15% in a single day, if not more, you're missing a lot of the upside that you're going to be able to capture maybe for the entire year, right? Because when you miss those big pumps, then you're essentially going to lack you might not ever catch up, honestly, right? So that's why it's really important to capture these. So this is what happened. And once again, the look back period here is the same. I think we have data available on this platform since September 25th. And this is what happened, right? So you see here, Coinbase pumped up really high, and our product was not able to participate that much. Then it was flat, our product was flat, and then we caught the downside, and then it pumped again, but we were not able to participate. So honestly, this is probably the scenario in which these kinds of strategies do worst. Like this is almost the worst case scenario for these fully covered call strategies.
Yeah, so that's why I've noticed the weeklies, when you are getting that whipsaw action, as it's often referred to, you're rebalancing weekly as well, right?
Yes, absolutely.
Okay.
And then this is just to give you an example, since this is just over, a few weeks period, right? So on the left-hand side, so let me just divide these two. So on the left-hand side, you have Coinbase stock, and the right-hand side, you have our options-based ETF or ETP on Coinbase.
Yeah.
So what you see here is that since we made the change, which is this really quick. Since we implemented the change, look at the upside capture, right? So this is very different than what we saw in the past. So here, while Coinbase was up 6.5%, we were able to capture almost the full upside in our product. Same here on the other days, almost fully matching it, if not slightly outperforming, and we see the same here. So I'm very optimistic that moving forward, we're going to be able to participate in a lot more of the upside, especially on the more volatile names, because for me and the team, that is it's key, right? Because if you miss just a few of those like really big move days, then you're going to be left behind. And this is an example just from yesterday, or I don't know when this video will be published, but let's say the move on Wednesday that we saw on Google, right? So they just made an announcement that they don't have to sell off their Chrome browser, and all that on the stock gapped up like 8-9% overnight. So Google closed up 9% for the day, which is what we see here, and then our
Yeah.
Google options ETP. And just to give you some background, right? For a stock like Google, a move like 9% a single day, I'm pretty sure that's a multiple standard deviation move. So this is not expected from a very well-known stock that, is not known for
Quite stable. Yeah.
these large moves. Yeah. And then we see the same here where just a few days ago we moved up 2%, we captured most of it. And then previously we moved up over 3%, and then we captured most of it here. So you can see the daily moves here on the underlying stock versus what's happening with our own product. And to give you an example, this is our underlying, this is the Tesla stock. That's the red line here, and our Tesla IncomeShares ETP is the white line, right? So this is since we implemented the strategy change. And as you can see, as Tesla moved up higher, 13% on a total return basis, we even outperformed it, right?
Yeah.
If you look at it on a total return basis. Price wise, so this is what you'll see on Google Finance or your brokerage platform. This is when you see just the price movement, you don't see
Yeah.
the total return, but even on a price basis, you see that the income product is actually kept up quite nicely with the underlying itself. So usually the difference between total return and this price return here, that is essentially the distribution that was paid out, right?
Yeah.
So that's why there's no difference on Tesla between price and total return. But on our product, you do see that difference between price and total return. And on the right-hand side, you see a similar story with AMD and our recently launched AMD product. So yeah, I mean, with the updated strategy, the main focus, at least initially, was to ensure that we're able to participate more in the upside. And I think we've been able to do it quite well until now. And then with the additional phases, and especially with the last implementation, we're also able to control exactly where we want to put our strikes to be able to capture a large yield as well, right? So as we know, the more closer you get to at the money, that's where you have the most juice. That's where you have the most extrinsic, as you explained earlier. That's where you have the most extrinsic, which is ultimately distributed to clients at the end of the month. So what we're able to do now is based on how volatile the underlying is, we're able to place one of the legs closer to at the money so we can capture more of that extrinsic, whereas the second leg is going to help us participate a little bit more in the upside. And of course, we have the uncapped equity sleeve, which is going to participate fully regardless of how far the underlying moves. And I actually shared this one on socials the other day, and a lot of people might be surprised to see it, but since inception, many of the products are actually in the green if you look at them on a total return basis. The information here, I think I saw some comments like, why is there a difference between this chart and what you see on your website for a particular product? Data is an issue in Europe, right? So it's very hard to find reliable data on NAVs and on close prices and things like that. So this data was pulled from Bloomberg, and when we first launched the product, I think there might have been 1 or 2 trading days that were missing, even on Bloomberg, right? So that's why you might see a slight deviation. So I hope that clarifies things for a lot of people that might have.
Yeah, I know a lot of people are getting confused because there's kind of the UK website and then there's the EU website, and then the inceptions for both were different. And then people are looking at total returns for the EU versions and the total returns for the LSE versions, and they're different as well. So the data's been a nightmare. People in the community know I've been following these since the beginning, and data has been a constant nightmare to resolve. So I think it's good to kind of see that in reality. You can see that those changes and how the new strategy is almost starting to work. I think what will be interesting is how it handles all the different market conditions.
Of course.
That will be kind of the litmus test for us. A question that comes up quite a lot is when do the distributions kind of show up in the NAV? Because there's been a lot of confusion where people will wake up Monday morning and the NAV's down and everyone's kind of like, that's a bit odd. Surely the options bringing from the previous week would have started to show up in the NAV. So it's kind of interesting where people are starting to track this, and they're kind of struggling now with that aspect. But we've been working a lot in the community to try and educate people around what the NAV means. One of the interesting things I think is quite good for you to cover is the difference between NAV and share price. And we hear websites talk about discount to NAV quite often. There's this kind of banded terminology, and people don't quite understand what NAV really means and what share price. I mean, they're technically very much the same thing, but there is a slight eons in the timing of everything in the markets. Do you want to talk a little bit around that and kind of help people understand that aspect a little bit?
Of course. And the confusion, first of all, is very understandable, right? Because let's look at the US market. So in the US market, once everything closes, that's when the NAV is ultimately calculated for, let's say, US ETFs. So there's almost no price discrepancy between the net asset value and the close price of a particular instrument. In reality, or in theory, I should say, they should always be very close to each other. Where things get a little bit tricky is when you have ETFs that are tracking stocks in one geography, but the actual ETF is trading in another geographical location. So what I mean by that is if you have a product that's trading in Europe and the underlying is in the US, right? So this is what happens. Let's take LSE trading hours, right? There's only a 2 hour overlap between the LSE and US exchanges, right? So what happens is the LSE market closes, but the products or the underlying stocks in the US, they continue trading for another, I think, 6 hours. And any move that happens in the US is going to be captured in the European product NAV, but it will not be captured in the European product close price. So that's why you will have this big difference all the time. And this is across the board for all ATPs or ETFs trading in Europe, tracking overseas instruments. That's why you usually have this big difference between what you see in terms of NAV and close price, right? Because let's say Tesla was relatively stable while both markets were open, right? And then all of a sudden, Elon Musk put out a tweet and then Tesla pumped 10% or vice versa, right? So that's going to be captured in the close price of, let's say, the US product, but in Europe, it's the close price, it's set and done, right? It's static. But once we're calculating the NAV, the calculations of the NAV are always going to be based on where the underlying closed in the US. So the NAV is always the best gauge for how the product is performing, right? Because we cannot control what happens after European markets close. So that's why you're always going to get this discrepancy between the close price in Europe and the NAV that you see here.
And to be clear, when people are looking at these sites like Yahoo Finance, Google Finance, they're all using the share price, right? They're not using the NAV price.
They're all using the share price. So all of these platforms were built for products that don't pay dividends, which is unfortunate for the community, right? So you're only seeing the share price movement. So like with the like you see with the dividend stock on X date, when it pays out the dividend, the share price drops, right? It's just a transfer of value. But unfortunately, free platforms like Yahoo Finance, maybe your brokerage platform, you're only seeing the price movement. So if you just see a downward move, I wouldn't take that at face value. You have to look at the total return to see what kind of dividends or what kind of distributions it made throughout the period, so you can actually make the calculation for total return and if that paints a different picture or not.
Yeah, and I think this is a challenge for a lot of people in the community is they see a share price or a share chart. We saw it with the puts, right? The zero DTEs when they first came out, everyone was like, these are decaying like hell. And then you look at then the total returns and it was like 6 to 8%, I think at the time, roughly.
Absolutely.
And so there's a different picture, right?
So sorry, I just wanted to add. So I mean, that's a problem for both the investors and for us, right? Because if the product's value is continually decaying, we as a business, right, ultimately we're trying to raise assets in the products, right? So if the product's value is decaying, that's one element of the AUM of a product, right? So if the value keeps going down, as a business, you're making less and less money. So that's not in our interest at all. So preservation of the NAV and trying to capture upside and making sure the products are performing as intended, that's in everyone's interest, which is, I mean, great.
Yeah, I think you've raised a very good point, which again, like we'd understand, which is as your net asset value declines, the amount of money within the fund is technically declining, which means that the amount of income that you're able to generate from the same amount is also declining. And another thing a lot of people don't realize is that when you're generating premiums, they're a percentage of the underlying share price. So if the underlying share price drops, the amount of premiums you're generating is also dropping. And I think people often forget the disconnect of the underlying almost in that. Yes, the IV can offset some of that, but it's ultimately still a lot depending on the share price underlying, right?
Yeah, I mean, the cushion, honestly, it is very limited, right? You still have that single stock risk with a lot of these products. But I think one of the key advantages of the put selling strategy is that when the market starts going down, all of a sudden puts start becoming a lot more expensive than calls. So that's where you might even be able to capture more
Right.
extrinsic value by selling puts compared to calls. But I mean, I don't really want to get into the technicals of all of it. But ultimately, it's our goal is to have an active communication with the entire community, right? Because we've never been the type of company that sort of pushes out a product and tries to convince investors that our product is the best and try to get them to invest in our product and not competitors. It's always been, let's hear the community feedback, let's hear the investor feedback, and based on that, let's see if we can address a need. Let's see if we can tweak a strategy that hasn't worked in the past. That's what we've been doing now for over 6 years. I've been with the company over 6 years now, and we've done that with all of the 150 plus products that we've launched, not only in Europe, but we also have a sister company in the US that just
Oh,
got
okay.
to 500 million in AUM just within a very short period of time. And yeah, I mean, we're doing, I think, a lot of interesting things across multiple geographies.
Yeah, and I think that's what's been really good for me to see is that, you've had a lot of slack because of the challenges, but you've kind of outlined that a lot of it was outside of your control, right?
Yeah.
And you've kind of had to educate market makers. You've kind of had to bring everything on board and get everyone
Mhm.
aligned, and that's not an easy task. And
Of course.
it's easy for us as retail investors to comment and say those
Yeah.
things, right? But
Yeah.
the reality is quite different. But I think what's good for me is you've been a lot more proactive in comms and a lot more about changing the strategy, doing
Mhm.
better within the boundaries that you're having to work within. So I think from my perspective, that's been great, and I hope that to continue. And I'd ask the community, even in the comments in this video or on the Discord, to continue giving that feedback or on social media like X, because I think it really helps the whole income community grow and the whole landscape and competition just grow. And I think it's good to kind of see what's been interesting from my perspective is, how different fund managers are approaching the income space as well. Like we've had yield mats enter the European market recently. We've
Yeah.
had rec shares enter the market recently. They're obviously coming through a third party, but it's good to kind of see that competition and for all the income kind of people. In terms of your perspective on the income market landscape, what do you feel about that? What do you feel like the opportunity is in Europe? And obviously there are some hurdles because you're dealing with different markets and different countries, but
Of course.
what's your kind of outlook on the income market landscape and the competition that's coming, or is it just arrived, I should say?
I mean, it's great. Like I said, I'm all for it. It's nice to see Yield Max enter the European market. I'm almost positive they'll come with more products because the
Yeah.
few that they've already launched have been a good success story. I mean, the same with Rex, right? And there will be more to come. But what I think differentiates us compared to the competition, and this is not just in the income space, right? This is just across the board in terms of what we do. We're very agile and we're very, for lack of a better word, quick, right?
Yeah.
So from idea generation to coming to market, I think we can do it at a speed that maybe no other company can do in Europe. And like I said, we have our own infrastructure for trading.
Yeah.
We have our own traders, we have our own strategies. And this is not something that we've been doing for since we launched IncomeShares, right? Just to give you an example, because we have the single most traded product on the London Stock Exchange, we've built a system where we're able to trade just massive amounts on a daily basis. I think I just checked just a few minutes ago, just before we joined the call. We're like the 42nd biggest institutional stockholder of MicroStrategy. I think we're like 60 something for Tesla, right? So we're moving like massive amounts of trading volumes every single day for our other funds. So there's no way to be able to manage over 150 products if you don't have that proper system in place and if you don't have that sort of experience over the years. So what I would say to the community is when we're not doing something properly, call us out for it, right? Because that's how you keep everybody on their toes and that's how you keep everybody competing. And when you have good ideas, feel free to share them with us because ultimately, like I said, we always want to bring products to market that people are interested in. And I think we're one of the companies that can do it relatively quickly. And obviously, we have some restrictions in terms of
Yeah.
what's doable, what's
Yeah.
not doable, what makes sense for us as a business and what doesn't. But I think we're really starting to push the boundaries in terms of what's possible. And we've already seen that with the progress that we've made with like the market makers and all of the other counterparties, right? So moving forward, we're going to be launching a lot more of these products. So I'd be very open to hearing some ideas around whether people are looking for more baskets, index-based products, commodities, whatever.
Yeah, I think the community, they are looking at baskets a lot more. I
Yeah,
think people are certainly the existing first batch, I would call them, of the beta testers of the income space have kind of struggled with that single stock. I think people underestimated the
yeah,
volatility aspect and what it meant. I think the lack of knowledge and understanding wasn't there at the start, and obviously these
definitely.
strategies have evolved over time. I think people are starting to feel a little bit more comfortable with the baskets now. So there's been a lot of investment growth in one of the yield max funds because of that aspect. I think I don't think it's
For
just the
sure.
yield max name. I think it's just the comfort factor of having that protection in a basket.
Yeah, yeah.
Personally, my aspirations, I'd love to see a leverage version, considering that's your
Okay.
background. We've seen them being done quite well in Canada in particular, with Harvest and a few other funds out there. But I also know that the risks are obviously a little bit higher with the leveraged element. But I
Hmm.
think we've seen some with very small leverage, like 0.25, and then we've seen some
Yeah,
with 1x. So I think just having that extra, I'm wondering, the only reason I'm curious is because you've got that uncapped leg
yeah,
and you've got a little bit of leverage on your other one, it
yes.
counteracts the loss on your other leg that you've sacrificed, the 25%.
Mhm.
So I think it would be an interesting one to certainly at least back test, because I think it might do quite well. But I sort of recognize the European market may not be quite
Yeah,
ready for that leap, but I can kind of see it coming. Another thing I think a lot of community are kind of pushing for, and I know this is a challenge and it's a difficult one because we've already struggled with the payments monthly, but people are really pushing for these weekly payments. And I know Yield Max have even sort of laddered them. They put them in groups. They're still monthly, but they've kind of
yeah,
grouped them up. So there's different ones each week within their selection. I think they've got a couple of weeklies out there, like Ulti and things like that. But I think that's something the community are really keen to see if you guys
yeah,
can pull off. I know it's not as easy in Europe, knowing we've got different
yeah.
countries and things like that.
So yeah, I mean, one thing I will say to that point is the plumbing in Europe is it's tricky, right, to say
Yeah.
the least. So when you by the time we send out the payments, which is done on the payment day, and by the time the money gets to the custodian and the custodian passes it on to the brokers, and then within the brokers, you have different ways of it reaching the end client, right? So it depends on how, let's say, technically savvy the particular broker might be. So I used to work for a brokerage platform myself in the past, so I sort of know what happens in the operations department, and sometimes it's not as, let's say, automated as a lot of people might expect. So there's a lot of fat finger mistakes, there's a lot of delays that can happen. Unfortunately, a lot of that is outside of our control, right? So all we can control is what we ultimately pay out on the payment day from our end. And then what we also do is push the brokers separately to try to get an update on what's going on with the cash, right? But yeah, the main concern, so because of this, let's say more confusing plumbing, the main concern that we have is that let's say we were to start paying out weekly, or let's say we were to even stagger the payments, right? So let's say
Mm.
we paid on the 15th for some of the products and then on the 30th for the
Yeah.
rest of the products. My worry is that we're going to have a huge backlog of payments that haven't reached the end investor and they're already waiting for their next payment, right? So those are the kind of things that are really worrying me and obviously the wider team. And then weeklies, actually it's the same story. I think at some point we will get to that finish line in terms of having the exact product that we want to run, because this idea about weeklies, right? We see what's happening in the US. We're obviously paying
Yeah.
attention to what everybody's doing. And we try to implement as much of it as we can here in Europe. But just Kathy Wood, when she entered Europe, you know what she called it? She said this is the most complex ETF market in the world, right?
Yeah.
Different jurisdictions, different tax treatment, different languages, different currencies. Everything becomes a mess, right?
Yeah.
So as soon as we can have those discussions and consider weeklies or even maybe like laddered payments, I would love to be the first income options issuer to be able to apply those to the products.
So you're not ruling it out completely, but you've kind of
Never,
highlighted there are some challenges there.
never,
Yeah.
never, never.
Yeah.
And I think actually this was decided like last night. We discussed it internally, but because you mentioned that element where people have no idea how much extrinsic we're able to collect
Yeah.
throughout the month and ultimately what the payment, will more or less be at the end of the month. what we're going to implement now on the website is this field where we have distribution pool, right? So on a
Okay.
weekly basis, people can see on a product at a product level how much that pool is growing. So even before we get to the end of the month, you can have a relatively decent idea of how much extrinsic has been collected and how much will be paid out the rest of the month. Because I know this kind of calculation was more straightforward with the covered calls, and
It was.
within the
Yeah.
holding section, like the entirety of the cash was the extrinsic, right? So now it's a little bit
Yeah.
more tricky. But yeah, we're going to make that available on the website. We're actually making a few changes to the website, but this is one of the elements that we are going to implement relatively soon.
And that's huge, right? We've got people that literally have got their own trackers. I built my own tracker to track all this information, and it's become really difficult to kind of get an idea of what it's going to be like, and people are always worried. And I think even the last payment, right, that there was quite a big drop in some of them. Coin, for example, I think dropped
Yes.
almost 60%, right?
Yes.
And everyone was kind of thinking, well, hang on a minute, it's a 5-week month. How did it drop so much? And then,
So,
yeah, do you want to
sorry,
cover that a little bit?
yeah, just to address that really quick. Yeah, so that's probably another element that we should cover is how many roles we're expected to have throughout the month, right? So I guess people were expecting 5 months, or I should say
5 months.
5 weeks
Yeah.
in August, which wasn't the case, right? Because the declaration date was exactly at the end of the month, so we couldn't include the last roll into the August payment. So in September, you'll have those 5 payments. So that's also something that we want to clarify a little bit more on the website. But yeah, I mean, that's why it's very important to keep hearing people's feedback, because we want to make these as easy to understand and transparent as possible, because obviously at the end of the day, the more clear it is for the end investor, the less explaining we have to do, right? So
Yeah.
that works for everyone involved.
Yeah, and I think it's really good that that transparency is coming through, and I think that website change, by the way, is going to be a game changer. I know there's been a bit of an up and down with the website as well. I know a lot of people have got concerns. Quite often, there's
Yeah,
been some sort of data challenges.
yeah,
Is something kind of being addressed around that? Because I know that a lot of people are kind of concerned about the reliability of the data on the website, and every time I've kind of quizzed you on it, you've kind of come back with a reason why, and the website's actually been okay. But I know
yeah.
in the past, and some things have kind of happened fairly recently, and I just want you to kind of maybe alleviate people, because you're talking about a website change. Everyone's like, well, that's great, but how accurate is it going to be, and,
Yeah.
and things like that. So
One thing I can say about us is we like to do almost everything in-house. So one thing you will see with many ETF companies is that they will just have a few key personnel and everything will be outsourced. And by that, I mean they might not do their own marketing, they might not have their own website, they might not have their own hosting. You can outsource basically everything within like the ETF ecosystem, and that's what most people do, right? And
yeah,
for us, we try to sort of internalize all of it. So we have a large team of programmers that are showing a lot of data points across our multiple websites. So we have a separate website for Leverage Shares Europe. We have a separate website for Leverage Shares UK. We have a separate website for IncomeShares EU and for IncomeShares UK. And then we have the US businesses. So those are another 2 websites. And I would say we have a lot more transparency on our website. I would probably challenge a lot of competitors to see if they're showing even a fraction of what we're showing on the other websites, especially. So we're going to get to a point relatively soon where the data is going to be even more reliable. It's going to be updated even faster, and we're going to be even showing a lot more data points, right? Because we even want to get to a point where people can sort of have their own login and they will have access to data that they would otherwise have to pay for. But that's,
oh, wow.
that's some thinking that we have down the line. But yeah, I mean that's I think one of the more interesting things about our business is we're not reliant on any outside financing.
Yeah,
It's a profitable company. This is a long-term game, right? We're not gonna try IncomeShares for a year and a half and also like decide to shut it down. We know there's an inflection point where things really take off. We saw that with Leverage Shares,
yeah.
over 1 billion in AUM just in Europe right now, and I'm expecting even things a lot bigger for IncomeShares. So I'm really anxious to see how the business grows, especially over the next few years.
I think that's a great update, and appreciate you sharing all of this stuff with the community and constantly being reactive. Really thank you for your time today. It's been brilliant to kind of put for the community to put a real proper face to all of the comms that's been coming out from X and through our Discord. And I think it's great for the community to kind of learn firsthand some of the kind of the ups and the downs, even as a provider of these funds, right? It's not as straightforward as people often think it is. I encourage people to put in the comments any feedback to Octay, any kind of feedback to me. Was it good? And I think me and Octay have aspirations to kind of do at least a couple of these so that you guys can kind of get that constant touch point with IncomeShares, and vice versa. IncomeShares will get something back. We have some giveaways planned. I'm still waiting for Octay to approve them.
On the way, on the way.
But some things are coming out for the community for those that stood by them through the ups and downs and the turbies. It's been good. So again, thank you for your time, Octay. I know you're traveling next week, so safe travels there in Asia.
Thank you. Thanks a lot, Sanish. No, it's been great. And like you mentioned, I'm really looking forward to making this a regular thing. I really wanted this to be an open discussion between us as the issuer and also the entire community. And you've been sort of the bridge. So, let's keep that momentum going and let's build something together that we're ultimately all proud of.
Great. Thanks a lot.